What if I told you that in 2008, the global financial system didn't just slow down, it almost flatlined? Not a small recession, not a normal market cycle, an almost total collapse of modern finance. ATMs were close to shutting down. Major banks were hours away from running out of cash. Global markets were in free fall. And governments had to inject trillions of dollars just to stop the entire system from imploding. This wasn't just another downturn. It was the moment the world realized how fragile the financial system really was. Today, we're breaking down the 2008 financial crisis, not as a boring history lesson, but as a blueprint. A blueprint of how bubbles are built, how systems reward risk, how psychology overrides logic, and how collapse becomes inevitable. But before we go deeper, make sure you like this video and subscribe, because on this channel, we break down money, psychology, and power in a way most people never hear about. Now let's begin. In 2008, the global financial system almost collapsed. Banks failed, markets crashed, millions of people lost their jobs, their homes, and their savings. Governments stepped in with massive bailout packages to prevent total destruction. But here's the uncomfortable truth. The crisis was not caused by one greedy banker or one bad decision. It was the result of a system that rewarded risk, ignored reality, and convinced ordinary people that housing prices could only go up. And the most important part, the same human behaviors that caused the crash still exist today. If you don't understand what really happened in 2008, you won't recognize the warning signs when the next bubble forms. So let's break it down clearly, not as a history lesson, but as a structural breakdown of how financial disasters are engineered. Because this is not just about the past. It's about how money, psychology, and power interact in every modern economy. To understand why this matters today, think about how most people build wealth. They buy a house. They invest in the stock market. They trust banks to keep their savings safe. They assume the financial system is stable. Now imagine that system suddenly freezing. Your bank might fail. Your investments might drop 40%. Your job might disappear. That's what happened in 2008. And it started with something that seemed harmless. Home loans. The first core idea you need to understand is this. The crisis began with easy credit. In the early 2000s, banks started giving mortgages to people who normally wouldn't qualify. These were called subprime loans. Many borrowers had low income, weak credit history, or unstable employment. Why would banks take that risk? Because housing prices were rising every single year. If a borrower couldn't pay, the bank could repossess the house and sell it at a higher price. It felt safe. But here's where psychology enters. When prices rise for long enough, people stop asking whether they should rise. They assume they will. This is extrapolation bias. We project the recent past into the future. If houses went up last year, and the year before, we believe they will go up next year too. Buyers believed it. Banks believed it. Investors believed it. Reality was ignored because momentum felt stronger than logic. And that belief inflated a massive housing bubble. Now we move to the second core idea. Financial engineering. Banks didn't just issue mortgages and keep them. They bundled thousands of loans together into complex instruments called mortgage-backed securities. These packages were sold to investors across the globe. On paper, this looked efficient. Risk was diversified. Exposure was distributed. But something dangerous happened. When banks stopped holding the loans, they stopped caring about borrower quality. If you can sell the risk to someone else, why be strict? This is moral hazard. When people don't bear the full consequences of their actions, they take more risk. Banks earn fees for creating loans. Rating agencies assigned high safety grades to these mortgage bundles. Investors chased higher returns in a low interest rate world. Everyone was profiting, so no one wanted to question the system. And this is where herd behavior takes control. When everyone around you is making money, caution feels irrational. Imagine managing a large investment fund in 2006. Your competitors are generating massive returns by buying mortgage securities. If you stay conservative, you underperform. If you join them, you look smart. Until the crash. This is how groupthink builds bubbles. Now the third core idea. Leverage. Leverage means borrowing money to increase investment size. Many financial institutions were operating with extreme leverage ratios. For every dollar they actually owned, they borrowed $20 or even $30 to invest. When asset prices rise, leverage multiplies profits. Small gains become huge returns. But when prices fall, losses multiply just as quickly. And here's the hidden danger. Leverage conceals risk during good times. When markets rise steadily, fragility becomes invisible. Profits generate confidence. Confidence turns into overconfidence. Executives receive bonuses. Stock prices climb. The system rewards aggressive expansion. But leverage makes the entire structure brittle. All it takes is one shock. And that shock came when housing prices stopped rising. Not crashing at first, just flattening. When prices stalled, borrowers with adjustable rate mortgages saw their payments increase. Some couldn't keep up. Defaults began rising. Investors realized those mortgage-backed assets were far riskier than advertised. Fear spread quickly. Now we reach the fourth core idea. Trust. Modern finance depends on trust. Banks lend to one another daily. Institutions rely on short-term funding markets. Investors assume assets can be sold tomorrow at predictable prices. But when uncertainty rises, trust evaporates. In 2008, major financial institutions began doubting each other's balance sheets. No one knew who was holding toxic mortgage exposure. Interbank lending froze. This transformed a housing problem into a liquidity crisis. Even fundamentally strong companies struggled to secure short-term financing. Then came the collapse of Lehman Brothers. When Lehman failed, it signaled that even major institutions were not protected. Panic intensified globally. Stock markets plunged. Credit markets seized. Businesses cut costs. Layoffs accelerated. Consumer spending declined sharply. This created a feedback loop. Less spending led to more layoffs. More layoffs reduced spending further. Economies contracted rapidly. Now the fifth core idea. Incentives. Financial systems are shaped by incentive structures. Before 2008, many executives were compensated based on short-term performance. Bonuses were tied to annual profits. There was minimal penalty for long-term risk accumulation. If a bank generated large profits for 3 consecutive years, leadership received enormous compensation. If catastrophic losses emerged later, shareholders and taxpayers absorbed the damage. This separation between reward and responsibility encouraged reckless expansion. Governments also contributed. Policies promoted home ownership. Low interest rates made borrowing inexpensive. Political leaders benefited from economic growth fueled by rising asset prices. Few wanted to restrict the boom, because slowing growth would have been unpopular. Short-term gains feel tangible. Long-term risks feel distant. Humans systematically discount the future. So the system drifted toward instability. When the crisis fully erupted, governments faced a difficult choice. Allow widespread bank failures and risk systemic collapse. Or intervene using public funds. They chose intervention. Massive bailout programs were deployed. Liquidity facilities expanded. Capital was injected into struggling institutions. Markets stabilized gradually, but public trust eroded. Millions lost homes and jobs. Large institutions survived with government support. This fueled political anger. Populist movements strengthened. Skepticism toward globalization increased. Trust in experts declined. The crisis was not only economic. It reshaped societies. It altered attitudes toward debt. It influenced regulatory reforms, including higher capital requirements and stress testing for banks. It intensified discussions about inequality. And here's the deeper pattern. Every major financial crisis follows a recognizable structure. A new opportunity emerges. Capital flows aggressively. Prices rise rapidly. Risk perception declines. Leverage expands. Confidence turns into euphoria. Then a catalyst appears. The bubble bursts. Afterward, warning signs seem obvious. During the boom, they felt invisible. Look at modern markets. Cryptocurrencies, meme stocks, real estate surges in specific regions. Digital platforms amplify narratives instantly. Information spreads in seconds. Herd behavior now moves at algorithmic speed. The instruments evolve. Human psychology does not. So what is the real lesson of 2008? It is not simply that greed exists. Greed is constant across eras. The deeper lesson concerns systems. When incentives reward short-term gain over long-term stability. When leverage masks vulnerability. When trust depends entirely on rising asset prices. Instability accumulates quietly, and most participants fail to notice. Because prosperity feels permanent while it lasts. In fact, prolonged stability often generates instability. When volatility remains low for extended periods, perceived risk declines. Borrowing increases. Risk standards loosen. Exposure expands. This is sometimes called the paradox of stability. The calmer the surface appears, the more fragile the structure beneath can become. This principle extends beyond finance. In organizations, in governments, in personal decisions. When preparation declines during calm periods, vulnerability rises. The 2008 crisis revealed systemic fragility on a global scale. A housing downturn in one country triggered a worldwide recession. Trade volumes contracted. Supply chains slowed. Emerging markets suffered. Because modern economies are deeply interconnected. And interconnectedness has increased since then. Today, capital moves in milliseconds. Global funds allocate assets across continents instantly. If confidence breaks in one region, shockwaves can transmit worldwide with unprecedented speed. Understanding 2008 is not about living in fear. It is about developing awareness. When prices surge, ask whether growth is supported by productivity or fueled by debt. When consensus declares an asset safe, question underlying assumptions. When returns appear unusually high, investigate hidden risks. These questions slow emotional decision-making. They reduce susceptibility to herd mentality. They enhance resilience. Because bubbles rarely feel like bubbles from within. They feel like opportunity. The 2008 financial crisis demonstrated how overconfidence, herd behavior, moral hazard, leverage, and distorted incentives can align within a complex financial architecture. When they converge, consequences scale globally. Regulations have improved. Capital buffers are stronger. Stress tests are routine. But regulation cannot eliminate human nature. As long as markets function, cycles will persist. Expansion and contraction. Fear and greed. Optimism and panic. The objective is not to eliminate cycles. It is to recognize structural fragility early. To build buffers before instability surfaces. Because the greatest danger in 2008 was not risk itself. It was the widespread belief that risk had vanished. And that belief, more than any individual failure, transformed prosperity into crisis.